Hello, everyone. It is 2 o'clock, so we will go ahead and kickstart this webinar. So welcome to our Investment Outlook webinar. My name is Leah Brady, and I am the marketing coordinator here at Journey Advisory Group. For this webinar, we are going to have a fireside chat with our founder and CEO, Tyler Lang, and our Chief Investment Officer, Eric Pettway. Tyler and Eric will be discussing what's going on in the financial markets today. At the end of the webinar, we will have a Q&A. To submit a question, there is a Q&A button on the menu bar. At any time during this webinar, you can submit a question. And please remember to keep yourself muted at all times. So without further ado, I introduce you all to Journey Advisory Group's founder and CEO, Tyler Lang.
Thank you, Leah, and hello, everyone. Welcome to our quarterly investment webinar. By now, you should have received our written quarterly market update. If you didn't get this, please reach out and let us know, and we'll be sure to get that over to you. We did something a little bit new this time. We added a section on planning, because at Journey Advisory Group, we do investments and we do planning. So you can expect that quarterly piece to always have an investment section written by Eric and a planning section on which we'll rotate topics to things like estate planning, taxes, financial planning, etc. We'll also rotate who writes on those topics because we have a deep bench of advisors, and we want to be sure that you're getting good information out of that quarterly piece. But today is focused on investments, so let's turn to our CIO, Eric Pettway. Hi, Eric. It's great to have you on again today.
Hey, Tyler. Good to see you.
Likewise. So, Eric, you've had a very impressive career. Starting way back in the late 90s, you worked as an analyst on Wall Street, and since then, you've continued to progress and evolve in your career. You've run equity strategies, you've managed portfolios for individuals, families, and institutions, and you've just gotten a lot of great experience that led you to your current role of serving as CIO of Journey. And also, everyone should know that Eric is now the president of the CFA Society of Cincinnati, and that's a great honor and a great responsibility. It's a pretty big deal. So Eric, share with us a little bit more about your role, what your focus is, and what we can all expect from you in terms of communications and updates.
Tyler, thanks for the opportunity to talk to everyone on the call today. I look forward to working with you in the coming years together, but I just thought I'd share a few points about how we're going to be working together and what I'm going to deliver to you as clients. First of all, you're going to see me writing the quarterly pieces. So every quarter you'll see the investment outlook, which will look at what happened during the quarter and what's our future view on the forecast. As well as I'll be hosting the webinar on an ongoing basis. This is our second webinar this year. We'll do another one in November. And then I do work with a handful of clients that I will continue to work with, and you'll see me in that front, as well as I'll be brought in on special situations to work with clients and throughout our JAG network. But as Tyler mentioned, my role is a CIO, so I manage the investment team, which consists of 6 individuals, including myself. We're dedicated to providing the best asset allocation, best structure, and the best solutions for our clients. What's unique about Journey Advisory Group is that we offer the best solutions to you as clients through both strategies that are managed in-house with our quality dividend growth, quality growth, and equity plus strategies. And then also we work with third-party managers to bring the best of breed to you and your portfolios. And as Tyler mentioned, I'm the new president of the CFA Society, which we have a little over 500 members here locally. What that entails for you as clients is I want to bring the best of breed of ideas from the best managers, because I meet with them on a regular basis, both globally, in the US, regionally, and locally. So the best ideas will be coming to your portfolio. And I look forward to working with each one of you and your families in the coming years together. Back to you, Tyler.
Great, thanks, Eric. So you'll continue to communicate via written quarterly pieces, webinars like this one, but a lot of your role is behind the scenes, managing customized strategies for our clients, analyzing companies, markets, and the economy as a whole. So let's turn to that. Taking a step back, just big picture here. The first half of 2021 is behind us. What are your overall thoughts as we look forward in the financial markets?
Great, Tyler. I thought I'd share a slide with you. So as you can see, the next 2 slides is going to be really on where are we in the valuation on the market. If you listen to CNBC, read the journal, there's a lot of discussion of, are we at the top of the market? And we would say no. And here's a couple of reasons why. One, let's look at the price to earnings, which is kind of the bellwether for looking at valuation. So on the upper right section of the chart, the most recent view is at the end of July, we were at call it 22 times forward earnings. That may seem expensive, but it's not the extreme levels that we saw back in 99, 2000, which was, looking back to the left-hand side of the chart, you'll see around 25 times. It is higher than the historical average of around 17 times. But if you look at where we're at on interest rates, the 10 years at 1.2%, that lower yield allows the valuations to be at a higher level than normal. But looking forward, as we look through earnings forecast for the next several years, earnings and cash flow are coming in well at expectations. Just looking at this quarter alone that we're not quite finished on, it's the majority, almost 90% of all companies reporting have reported better than expected top line revenue, earnings, and cash flow than expectations. And if you look at the earnings projections for just the 2021, 2022, and 2023, numbers are going to go up. So if you look at the valuation going to 2022 and even 2023, the valuations are going to come down even at these levels. So we're looking at around 18 times for 2023, and that in the current climate is actually a very reasonable multiple for equities. As we look for our clients' portfolios, going forward, we do want to tilt in favor of equities. The opportunity set is much greater in equities right now, and we do see upside through the end of this year and through the next several years. Inflation, which we'll talk a little bit later, is an important factor we look at, but equities are a natural hedge against inflation because as companies can price that higher inflation into their pricing, and then margins lift, and then cash flow lifts as well. So that will roll into market appreciation. So our advisors are still managing to around a 60-40 mandate for our clients, and we still forecast that as a proper asset allocation going forward.
Great, thank you, Eric. So yeah, a lot of different ways to look at valuations. Not all of them are concerning or showing overly valued. If you look at just that price to earnings, that PE ratio, that chart that you have up there, it could appear to be alarming because last time we were at these levels was right before when the dot-com bubble burst. But like you pointed out, there's other ways to look at valuations, and a lot of them show that we're within normal ranges. So shifting gears a little bit, Eric, let's turn towards inflation, okay? I think we're all feeling and witnessing some inflation, whether that's in housing, in restaurants, just in a lot of different ways. And we discussed this in our webinar back in May, but let's revisit inflation. So what's the data telling you right now, and should we be worried?
Thanks, Tyler. Let's if we rewind back to our last webinar, go back to that slide, correct, thanks. If you look back at what we talked about last quarter in May, we talked about inflation and interest rates. We're going to continue to talk about this during the webinar. I'm showing 6 slides here, or 6 charts of 6 commodities that have gone through the peak cycle. So they've already peaked and prices have come down dramatically. So whether you look at lumber on the upper left-hand corner, or corn or wheat or soybean or lean hogs or copper, prices have come down. What we would expect going forward is as supply will meet up with demand and prices will mitigate even further. So we are in the camp that inflation will be transitory, just like the Federal Reserve, and we would expect inflation rates to be more tame going forward. One stat that I looked at recently was that over the last 2 years, if you look at beginning 2 years ago to today, inflation is around up 6%. So if you annualize that, it's only 3%. So we are not at the hyperinflation rates of the 70s, and we're not at the higher interest rates level. So this is a good backdrop for the economy. As we see, the Federal Reserve has come out again, and also the UK central bank has come out this morning that they're leaving interest rates at a low level. So we're seeing the central banks remain accommodative. We're seeing inflation coming in over time. We would expect that to be mitigated. So that's a really good backdrop for equities and the financial markets going forward.
Great. Yeah. Thank you, Eric. So yeah, inflation is definitely a very difficult thing to forecast. It can also be pretty scary. You just think back to the 70s and 80s when our economy got rampant inflation. So the Fed, led by Paul Volcker, raises rates to get inflation under control, and the result is back-to-back recessions. There's an old saying that says once the inflation genie is out of the bottle, you can't get it back in the bottle. But Eric, I think you've outlined some encouraging data that indicates the inflation genie may not be out of the bottle just yet. So we'll continue to keep a close eye on that because it does have important implications. So, and inflation has direct implications for interest rates. So let's turn to that topic, Eric. Just give us an update of what you're seeing in the interest rate landscape and where interest rates are heading.
So this chart that I'm showing here looks back to around 2016 through more current times, and it looks at the 10-year. And as you know, the 10-year is benchmark for the Barclays Agg, which is really the bellwether for the bond market, as well as for mortgage rates. And we've been through a roller coaster level of rates. We were at 1.5% back in 16, and that went up to about 3.25% in 2018. And then it came down dramatically to almost 50 basis points in 2020, rising to about 1.75% in the peak of this year. And now we're around 1.2%. So we lived through quite a bit of surprise, especially in the shaded box here. Looking into this 2021 and our forecast for this year, we were looking for rates to go up over time, but more of at a gradual pace. But they spiked up at the beginning of this year, and now they've come back in. And a lot of it's, there's two main factors that are causing interest rates to surprise on the downside. The first is, central banks across the globe are continuing to be accommodative, and they wanted to maintain lower interest rates because they're looking at inflation as being transitory, as we talked about. There's also a technical shift where coming into the year, the large hedge funds and portfolio management teams were short on the fixed income curve, and they had to cover once rates came down dramatically. So that's more of a technical change. But looking forward, as inflation starts to be more mitigated, more transitory, we do believe that rates will stay at a low level. But where we are still looking for a gradual increase, but not nearly at the rate that we saw at the beginning of the year. And we are monitoring this, on a regular basis for your portfolios. As a rule, we are focused on the short end of the curve for both bond ladders and in bond funds, and that's served you well in your portfolios because we have sheltered the majority of the interest rate risk that has been faced this year. And whereas the Barclays Agg is down, and a lot of your portfolios, you're flat to slightly up. So we feel that we've helped out with the portfolios in that respect.
Yeah, great. It's still pretty incredible, what's going on with interest rates, especially for those who lived through the 70s or those who have studied market history when rates were in their teens and they even popped up over 20%. And now we're talking about rates in the low single digits. And in some parts of the world, there are even negative interest rates. So at this point, we're going to move on to Q&A. So there's a button at the bottom of your screen where you can ask questions. I will hand it over to Leah and she'll coordinate things for us from here. Thanks,
Thank you, Tyler. The first question that we have is about international investing. And the question is, how should we think about international stocks in our portfolios?
Thanks, Leah. And this is an important topic that comes up in a lot of our client meetings. We approach this in a couple of ways. One, we tend to have more of a U.S. multinational focus. So we do invest in global nature, for example, in Procter & Gamble or Microsoft that have more than 50% of their sales overseas. But that is only one way to participate in the international side. Where we also like to participate is in active managers that are focused on more regional side. So they'll work with companies that are focused on just sales in Europe, Southeast Asia, Africa, Latin America. Because right now the multinationals are getting a global exposure, but not the unique perspective in those local markets. We do believe that going forward, international markets have been tough years, but based on the valuations and what we're seeing compared to the U.S., we do recommend increasing, especially the developed side of international markets going forward, and we're starting to do that in client portfolios. So there's still opportunity. We are still U.S. focused, but there are opportunities to diversify and put money to work in more developed international side of the markets.
Yeah, great. And I just, those are some good points. I just reiterate that we do believe having an allocation to international assets outside the US, we do believe that will improve risk-adjusted returns for long-term investors. But also one of our core philosophical tenets is that we customize portfolios for our clients. So each client has unique needs. There's not a one-size-fits-all approach. So for purposes of this discussion on international investing, it may not be the right thing for you. So just talk to your advisor about that if you have more questions on it. There was one question that also came through about if there are any investment options for the China market and its tech stocks. And the short answer to that is yes, there are. But please reach out to your advisor and or one of us, and we'll definitely talk to you more about that. So Leah, I'll throw it back to you.
Okay, thank you, Tyler. The next question is on any thoughts on how the increase in pandemic, spikes in cases, et cetera, will affect U.S. and global economy of the short term for 6 months or otherwise?
No, there's no question that the Delta variant is increasing. If you look globally, really started outside the U.S. and is now spreading to the U.S. I would say on the positive side, what we're looking at in the UK market is that indications that the spike was a kind of a 40 to 45 day window. So actually the caseload is coming down dramatically. So if you extrapolate that to the US, and we're kind of thinking we're in the middle to the upward swing in Delta variant, there is light at the end of the tunnel. If you look at the companies that we invest in, our focus is on high quality companies that are generating good cash flow and earnings in all markets. And those companies have been around and have survived many different situations, whether it be the global financial crisis, the COVID crisis, the tech bubble. So when we invest for the long term. We're investing in an active style where we're making choices on specific names that can do well in these environments. As far as the something that we're monitoring, but we'd say that from the one thing that is of note is that the GDP forecasts over the kind of the back half of the year have started to come down. The most recent GDP report for this current quarter was down at a 6% level, which is actually down from 8% expectations. So we're starting to see some growth come down, and you're also seeing that reflected in interest rates and the growth projections for the 10-year. But going forward, we do also see some opportunities. We're seeing many of the companies, large corporations, are benefiting by having less corporate office. There still a lot of the large corporations are working from home. Their overall travel expense and their operating expenses are coming down, so the margins are lifting. So there's constantly, at any time, there's positives and negatives, but we see that the positives are outweighing in the economy, and that will be beneficial for the financial markets, specific names that we invest in.
Great. Thank you, Eric. The next question that we have is, if the commodity price of lumber is so low, why is the price of lumber 5 to 6 times higher?
Well, if you go back to that chart, the lumber price spiked based on a divergence between supply and demand. And so we saw, and we've seen this across the country, is there's been tremendous demand for not only residential new construction, as well as for putting additions on homes. So that spike up was on a relative basis. You can see that in 2020, we were at a much lower level. There was a spike, and now the supply is coming online. So over time, we would expect that to reach equilibrium more with the long-term trend. I did want to also go back to one slide that we kind of talked about in valuation. Tyler hit on it, but I want to spend a little time on the price of free cash flow, because cash flow is really the core of what companies generate. It's what they bring in the door and what they generate that can go back to the business. It can go to dividends, and it can go to buybacks. So if you look at the chart, we are really at more normal levels on valuation. The price of free cash flow is around 29 times, but the average is around 26. So compared to price to earnings, we're at a very relatively low, still low level. And looking at the two peaks you'll see there, 2008 financial crisis and then the dot-com bubble, which were peaked out at almost 70 times free cash flow. We're not nearly there. So based on cash flow, which is really the key, what the most investors look at, we're still at good levels for investing.
Great, thank you, Eric. The next question that we have is, any thoughts on current conventional wisdom on both gold and cryptocurrencies?
Sure. So we do have, specifically on cryptocurrency, we do have an exposure through our Equity Plus, which is a thematic investing strategy. We do invest through the Grayscale Bitcoin for clients that want to have a exposure there. As far as one misnomer is the Bitcoin and the cryptocurrencies are truly assets rather than cryptocurrencies. They are being traded for goods, but how we evaluate it is it's an asset class that's a diversifier against other securities you may have, equities, fixed income, real estate. The reality is that, especially with Bitcoin, there's a finite amount of supply. So it grows at around 2.5% per year, and it's going to cap out in a few years at a certain level. So what we look at is the demand is starting to come in stronger from both retail institutional investors as an asset class, and we do have a small position for clients that want to take some of their large cap equity and put it towards that structure. As far as gold, we do have a more focus on silver, where we do believe there's more demand and also more uses of gold in the marketplace. Silver. So gold is certainly in the earlier days was a hedge against inflation, but what we're finding is that other structures like Bitcoin and other cryptocurrencies are almost the gold 2.0 because of gold's has kind of lost its luster over the years. So we do have more exposure to silver, and we do have a limited exposure to Bitcoin in some of our client portfolios.
I guess I just add to that I'm not sure there's any conventional wisdom when it comes to cryptocurrency. You know, the concept is beautiful. The notion of not having the control of the supply be determined by a government or a governmental entity, but the regulatory environment is just a huge unknown. So there's elements of it that we really like, and there's elements of it that are really, really uncertain. I think it does go back to the notion of it's not for everybody, but it might be right for you depending on your situation.
Thank you, guys. So it looks like we have time for one more question, as long as we're just trying to stay in time with everybody. But if for whatever reason we did not get to your question, rest assured that we will make sure to answer your question, and your advisor will reach out to you to answer that. So with that, the last question that we have is on new tax proposals. And should we do anything now to prepare?
I'm glad you asked, Leah. It's it's an easy question to answer in like 7 minutes, right? So it could take several days, and we are monitoring the situation. We do have an advisor that's a CPA and is a tax advisor, works with some of our clients on taxes. And as a matter of fact, he, as long as his partner Pete, will be doing a webinar in September, so on taxes. So feel free to sign up for that. More to come in the future, where we'll do similar 30-minute format. But as far as taxes, we would say that everything is fluid, and as far as it's all based on the political kind of calendar. Right now, the most important calendar item is infrastructure, which looks like at least the first bill may get through in the next week or so. Then there's a slew of other items that have to come through, and there's a limited window for the tax window before midterms come in for next year. So what we would expect is that overall rates are not going to, there's a tendency to go up, And as my administration has stated, there's a focus on higher taxes for individuals who are making over 400,000 in income. But some of the strategies that we do talk to our clients on a regular basis on taking advantage of the annual exclusion every year for family members and non-family members, looking at your estate versus the current exemption and looking at different strategies. And we can work with you on those kind of structures. But the reality is it's a fluid situation. If you also have charitable intent, we can talk to you about those situations. We cannot write the trust documents, but we can get you up to the point where you work with your attorneys to make that happen, and that saves you on the cost because you're paying the fee of that process, and our planners can work with you on that detail. So I would say more to come on taxes in September, and make sure that once that invite comes out, put that on your calendar, and we should know more in more detail then at that time.
Yeah, no, I just add to that, and then I'll kind of wrap things up here. I think that's a nice segue because, yeah, we are going to be talking more about that in September. There's a lot of uncertainty right now, so hopefully we'll have some more clarity on that. But we'll be talking about some strategies that you might be able to put in place, and there will, of course, in that next webinar, be the opportunity to ask some deeper questions on taxes as we have more information about what they're going to look like. So be sure to sign up for that. So, hey, thank you very much for attending our Investment Outlook webinar today. We appreciate your time and hope that it was beneficial. So thank you, and we hope that you have a great rest of your day.